Hello young traders, doing over there from DRFX, swing trading mentoring. Gonna be taking a look at a recent trade that was made on the New Zealand Japanese yen, which provided us with a strong trading gain of 100 pips, as we took advantage of the consolidation setup that was being completed on the daily chart of this currency pair. So I'm gonna be going through the main technical factors that supported this trade on both its daily chart and 4-hour chart, to basically showing the main advantages of using Japanese candlestick signals, trend lines, and consolidation setups in allowing us to maximize on the trades provided by the daily chart and the 4-hour chart ahead of sharp reversals, so that we can remain profitable and successful in this $1 trillion market over the long term. Now here you can see in a section from my website which basically describes the new trading approach which began in February of this year, where basically what is done is to target trading gains of between 50 pips and 70 pips within a 24-hour holding period, using the Japanese candlestick signals and patterns provided by the daily chart and the 4-hour chart. Where possible and justified, trading gains of between 70 pips and 100 pips are also targeted, and we extend the holding period from 24 hours to 2 days in order to be able to capture these larger trading gains. Here you can see the graphical summary of this trading strategy, where for the most part, trading gains of between 50 pips and 70 pips represent the majority of the trading targets that are captured. But in certain situations, trading gains of between 70 pips and 100 pips are also targeted. And in some cases, where justified, trading targets of less than 50 pips are also targeted as well, with a minimum trading gain of 35 pips. So this represents the new and aggressive trading strategy which began in February of this year, which is expected to carry us towards large rate of return targets in the months ahead. Here again you can see the basic approach, which is to identify market direction using the daily chart and the 4-hour chart. When a trading opportunity has been identified, entry then takes place using the signals and patterns provided by the 4-hour chart. And to protect the trade until the trading target has been hit, we use the strongest areas provided by the 4-hour chart that will protect the trade and keep us away from temporary pullbacks until our trading targets have been hit. Now, there are actually 3 main setups that are traded as part of my new methodology. This one being the first one that we target, which is basically the setup that was traded on the New Zealand Japanese yen. Essentially what is done here is that instead of waiting until a consolidation setup has been finally completed with clearly formed resistance and support boundaries, what we do is to identify the early set of bearish and bullish waves that indicate that the market is going to be forming consolidation, and we trade those waves until the consolidation has been completed. So what this does is that it gives us the added advantage of the trading gains that can be captured when the consolidation has been completed, as well as the early gains that we can actually capture as the market is completing the formation of these setups. The second setup, of course, is that we continue to trade within the boundaries of consolidation and resistance once these have been completed. So these 4 represent the 4 main types of consolidations that we will see on the daily chart and the 4-hour chart that generally provide us with strong and profitable trading opportunities. So we will either be trading ranges or pennants. Ranges are where the market moves sideways and allows us to form horizontal boundaries of resistance and support. Whereas with regards to pennants, we can have 3 types, with the support and resistance boundaries formed at different angles to each other. And the one that we're going to be taking a look at on the New Zealand Japanese yen is actually an example of a range consolidation setup that was actually going to be completed. The third setup that we trade is to trade false consolidation breakout reversals, where the market will attempt a breakout at one end of the consolidation and then stall and head back inside of the consolidation. So there are various types of signals and various types of ways in which these reversals can take place. And once the signal is strong enough, then we can take advantage of them and trade the market as it heads back inside of the consolidation setup. So these are the 3 main setups that are traded as part of my methodology, which you will see being traded on several currencies over the next several days and weeks. Now, the platforms that I use are FXCM and FX Pro. FXCM is used to identify market direction and entry signals, basically because this platform provides what I find to be the clearest and the most accurate signals, especially based on the New York close of the daily candlestick signal, which is the cornerstone of candlestick signals, candlestick methodologies like mine. So FXCM is used to identify market direction and entry signals. However, when it comes to my live trades, I actually use FX Pro for two main reasons. Even though FX Pro also uses the New York close of the daily candlestick signal, the first main advantage that it has is that when you're actually executing a trade, you can actually see the exact risk and reward values for that trade in percentage values. So this ensures that you're going to be keeping within your risk parameters and that you're able to capture a rate of return that justifies the risk for that trade. Of course, the second advantage is email alerts. And I highly recommend that you either use FX Pro or any other platform that allows you to receive email alerts. The main advantage of this is that after you have entered a trade, you do not have to constantly monitor the trade and monitor the chart until your trading targets have been hit. You can simply close the platform and wait until the platform sends you an email informing you that the trading target has been hit. This provides the significant advantage that you do not end up self-sabotaging your trades and self-sabotaging your profitability over the long term. Because what can happen is that as you constantly look at the chart, every single pullback that takes place against your trade, which may be temporary, might be justified as a reason on your part to exit the trade too early and forego the larger profitability that the market would have given you had you stayed in the market and only exited at your original trading target. So this is one of the advantages of using a trading platform that provides you with email alerts so that you do not fall into the bad habit of constantly monitoring your trade and constantly being tied to your trading screen unnecessarily, wasting a lot of time and energy. And at the end of the day, in most cases, you will close out most of your trades too early, which, even though it might prevent you from losing, it will also prevent you from maximizing on the trading gains provided by the market. So assuming that most of your trades are going to be correct and that you have a profitable trading strategy, then it means that most of your trades are going to be correct. So there's no point in actually constantly monitoring your trade and being constantly glued to the market. So the main advantages of this approach that I've created is that by using the larger time frames, you're going to be basically taking advantage of more stable signals compared to the lower time frames. As a result of this, your forecasting accuracy is going to be much greater, and your entry is going to be based on signals that are more reliable with fewer false signals compared to the whiplashes that you see take place on the smaller time frames. Of course, with my approach, we're trading high probability setups. So this means that on average, trades take place 1 to 2 times per week. And if each of those trades provides a rate of return of between 3% and 4% for the most part, then it means on a monthly basis, you really do not have to trade. You really just need around 4 to 5 good trades on a net basis in order to be able to capture a large rate of return of on average 20% per month. So that is what is possible from this strategy, where we patiently wait on the best trading opportunities that can provide us with large rate of return so that we do not have to trade several times per month. Large gains are going to be possible for each month and is going to guarantee us long-term profitability over the long term in this $1 trillion market. Now to the trade itself. Here you can see the summary of this trade, which gave us 100 pips on the New Zealand Japanese yen. And for many of you traders, this would have represented a rate of return of anywhere between 2% and 6%, depending on the level of risk that you would have taken for this trade. And as you can see here, for me and my live account, this actually represented a rate of return of 4.16%. Now, this trade followed the previous one on the New Zealand US dollar, which gave us 46 pips and a 4.62% rate of return on my live account. These two trades were the latest in a series of positive trading results from my methodology over the last several weeks. This has translated into a strong rate of return of 24.32%, which represents the performance of the methodology since it began in February of this year. What this means is that, assuming that the next set of trades also provide average rates of return of 4% each, then it means, according to this table, which represents my rate of return targets, only 2 trades are now left to hit the 30% goal, 6 trades are left to hit the 48% rate of return goal, and 20 trades are left to hit the major rate of return goal of 119%. This table actually assumes a conservative monthly rate of return of 7% over a 12-month period. Now, the trade setup that was trading on the New Zealand Japanese yen was an example of trading the bullish and bearish waves that lead to the completion of a consolidation setup. So here you can see the daily chart of this currency pair, where the market was basically in the process of completing this range consolidation setup. Support boundary had already been formed with these 2 support points. Resistance point had already been formed at this area here. And the second resistance point was now being completed by this U-turn and this strong bearish signal. So the expectation was that based on the strength of this signal, this U-turn was going to continue and start another bearish wave that would take us down to the support and confirm this as the second resistance point, completing the formation of the resistance boundary and therefore completing the formation of this overall range setup. So with this strong signal given, strong U-turn and the strong bearish signal given, the expectation was that not only was the market going to be headed toward the support boundary, but it was also going to be providing us with a strong trading opportunity as well to take advantage of this movement. So with that setup, with this scenario seen on the daily chart, the next thing was to go on a 4-hour chart to identify an entry opportunity to take advantage of this expected decline. Now here you can see on the 4-hour chart that the market had actually formed this range consolidation setup and that a fairly strong breakout had started below support. So the setup and the signal and the breakout signal on the 4-hour chart was actually what led to the U-turn and the strong signal that we see here on the daily chart. This was actually another example of the relationship that exists between the daily chart and the 4-hour chart, and more generally, the relationship that exists between specific pairs of time frames on the currency market, all the way from the monthly chart all the way down to the 1-minute chart. So there's a unique dynamic that takes place that is explained in detail in my manual, which explains the relationship between these consecutive pairs of time frames and how the lower time frame leads to the signals provided by the daily chart. And once that signal is given by the daily chart or the larger time frame, it then dictates what will continue to take place on the 4-hour chart or on the lower time frame. So given this setup and signal that led to the daily candlestick signal, and given the fact that this looks strong, then it had a very strong chance of leading to the movement towards this area here and continuing the movement that was started on the 4-hour chart. Now, in terms of stop loss placement to protect the trade, this downtrend line was formed as part of the breakout from this consolidation setup. So this is one of the areas that we can place our stop loss above on a 4-hour chart to ensure that we can stay in the trade until the trading target has been hit. From the trading manual, once again, you can see here an example and a description where when we're breaking out from consolidation setups, once a breakout has taken place and it's strong and clear, we can draw trend lines across the highs of resistance points, that are formed as part of the breakout. And once the breakout is strong enough, then the trend line is usually also strong enough, and it's also a very strong area to place our stop loss on the 4-hour chart. So the stop loss was placed at 74.44, comfortably above the trend line and the bearish candlestick signal here, with entry taking place at the close of this bear candle, which coincided, of course, with the close of the daily candlestick signal. Trading target was set at 100 pips, which was expected to be captured within 2 days, and which was expected to be captured well before the market actually hit the support target. So with a larger range of movement taking place with a larger consolidation setup, this was an example of trading targets of more than 70 pips, and where we would have to extend the holding period from 24 hours to 2 days in order to be able to capture these larger trading gains. So the basic summary of this trade setup was that the daily chart was heading to the support boundary as part of the formation of the consolidation setup, and entry was going to take place at the close of the daily chart candlestick signal, with the stop loss placed above the 4-hour chart trend line, which was formed as part of the breakout from the consolidation on that time frame. And because we were trading the larger movements of the market within the context of a larger consolidation setup that was being formed, trading target was extended to 100 pips, with the holding period extended to 2 days. So this was the setup that was sent to my subscribers, detailing the main technical factors that supported this trade. And as you can see here, within 2 days, the market provided us with a trading gain of 100 pips as it headed towards the support target in response to this bearish candlestick signal. So the consolidation setup was basically formed on the daily chart in the form of the range. And you can also see it here on the 4-hour chart of this currency pair as well. After entry took place here, stop loss was placed comfortably at 74.44 above the downtrend line and was not affected any at all, especially by this small pullback that was taking place here. So the market declined as expected, with a few waves taking place along the way. Again, another example of why we should not watch our trades, because we may have been tempted to exit the market here at these pullbacks and sideways movements here, and we would not have been able to enjoy the strong trading gain of 100 pips. Here, of course, you can see this on my live account with FX Pro. Daily chart completing the formation of a consolidation, responding to this bearish signal and providing us with a 100 pip gain in just 2 days. Once again, the summary: 100 pips provided by the market and a 4.16% rate of return. And on the left hand side here, you can see the trade alert that was provided by FX Pro, informing me that the trade had hit the trading target. So what are the main highlights of this trade? Well, it's another example of how we can take advantage of the formation of consolidations instead of waiting until the consolidation has been finally completed and then trading between resistance and support. So this approach allows us to capture early trading gains in the early stage of the formation of the consolidation, and add those profits to the profits that we will also capture by trading between the completed resistance and support boundaries. Trend lines can be used for stop losses. In this case, we used the downtrend line that was formed as part of the breakout from consolidation on a 4-hour chart. And with larger consolidation setups, we are able to capture larger trading gains of between 70 pips and 100 pips. And these can be captured quite comfortably by extending the holding period from 24 hours to 2 days. Also very important that we identify the consolidation boundaries correctly. So that means that we use the right technique in identifying support and resistance boundaries. There are several techniques and several approaches that people use to identifying support and resistance, many of which depend on their interpretation of how they use the low points of candles, whether they include the wicks of these candles or just use the body of the candles. In my training manual, I go into detail as to the preferred method, which I think is the best way to accurately identify these boundaries so that we can exit at the right time, so that we do not get caught up by early reversals by not drawing these support boundaries or resistance boundaries correctly. Waiting for the right entry signals is very important. Even when we have identified the consolidation boundary and expect that the market is going to be moving from one boundary to another, it is very important that we enter at the right time, because if we're entering at too weak of a signal, if the signal is too weak, then it means that we can encounter unexpected pullbacks and reversals that lead to trading losses. More importantly, and very important, all of that hard work that we do in identifying a trading setup, market direction, and an entry opportunity will all go to waste if we do not have the discipline to stay in the trade and do not watch the trade until the trade has been closed. The natural dynamic of the currency market, like any other market, is that it will wave back and forth and will not always go towards our trades in a straight line. The only exception is where our entry takes place or coincide with a major fundamental news announcement that causes the market to react in the same direction that we were going to be trading. And it is something like a major news announcement, like a non-farm payrolls or an interest rate decision, which, as you know, can lead to fast and aggressive movements. And in those cases, the market does not pull back and usually hits your trading target in a very short period of time. But those are the exceptions to the rule. And the rule is generally that the market will pull back and wave and even move sideways for a little bit, which means that we have to have the discipline to not watch the trade, because we can be easily tempted to start to worry and put unnecessary stress and pressure on ourselves, and which in most cases can lead us to close our trades too early. So once we have the discipline to not watch the trade any at all, then it allows us to be able to capture large trading gains of up to 4% per trade in just 2 days, which I believe is a fantastic result in this $1 trillion market that has such a high failure rate of up to 95%. So in summary, once again, these 8 steps will keep us profitable over the long term in this $1 trillion market and ensure that we accurately identify what is taking place in the currency market. So once you have identified a currency pair that we're going to be trading, the first thing that we do is to identify whether or not the market is trending or whether it's going to be moving sideways in forming a consolidation setup. Once that is determined, we then make a forecast in terms of its expected bullish and bearish movement over the next several days. And also we identify some of the market traps that the market can set for us, such as false consolidation, breakout reversals. So once these 4 steps are out of the way, the next thing to do is identify our trading target. And since most of my trading is done within the context of consolidation setups, these are going to be set in terms of support and resistance targets. Once an entry opportunity has been identified, we then need to identify the strong stop loss area that's going to protect our trade and enter at the right time and the right signal provided by the daily chart and the forward chart. As I said before, in most cases, the holding period is set at 24 hours for the smaller trading targets and 48 hours for the larger trading targets. So once you follow these 8 steps and once you follow the rules and guidelines that allow you to accurately identify market direction and take advantage of profitable trading opportunities, you will be able to capture these types of trading gains on a more consistent basis in both the short term and the long term, allowing you to basically capture several trading opportunities provided by the market each month. So most of these trades, such as the ones that you see here, were done within the context of consolidation setups. So it's very important to be able to identify the consolidation setup that has been formed and the entry signals on the 4-hour chart that will allow you to take advantage of these movements and capture these trading gains on a regular basis. So until next time, traders, take care. Of course, you can email me at shepherddwayne@gmail.com if you have any questions about this trade or on the methodology itself. You can also find me on Facebook and babypips.com using the username DRFX Trading, as well as on Twitter at worldwide876 is the handle there. So again, if you have any questions about this trade or about the methodology itself, which targets trading gains of between 50 pips and 70 pips, and in some cases, as was the case with the New Zealand Japanese yen trade, trading gains are between 70 pips and 100 pips with a larger holding period of up to 2 days. So until next time, traders, all the best and enjoy the currency market.